These two guys are about to teach you the most important concept in all of investing. One of them is along for a wild ride, screaming with his hands in the air. The other one barely notices anything is happening at all, calmly checking his watch. Most beginners use the words stocks and bonds like they're the same kind of thing, like picking between two flavors of the same investment. They're not even close. One of them means you own something. The other means you loan someone money. And mixing that up is the difference between building real wealth on purpose and panicking every time the news gets scary. Turn on financial news for 10 seconds, and you'll hear the market thrown around like it's one single thing. Stocks went up, bonds went down. The market is reacting, and if you don't already know the difference, it all blurs into the same confusing noise. Even the word investing gets used as if it only means one thing, when really it covers two completely different relationships with your money. One where you become a part owner, and one where you become a lender. So let's fix that right now, with two simple stories, because once you separate these two ideas, you'll never confuse them again. Imagine your friend needs $1,000. You lend it to him, but you're not doing it for free. He signed a simple agreement. In exactly 1 year, he'll pay you back your $1,000 plus an extra $50 as a thank you for the loan. That extra $50 is interest. That entire transaction, that's a bond. When you buy a bond, you're not buying ownership of anything. You're lending money, usually to a big company or a government, who needs cash to build something, fund a project, or cover everyday expenses. In return, they promise two specific things. They'll pay you a fixed interest rate along the way, called a coupon, and they'll return your original money, the principal, on a specific date called the maturity date. In the real world, the friend borrowing your money is usually one of two types. It might be a government like the U.S. Treasury borrowing to fund public projects. These are generally considered some of the safest loans in the world because a government can raise taxes or print money to pay you back. Or it might be a corporation like a major airline or retailer borrowing to expand its business. These pay a bit more interest than government bonds because lending to a company carries a bit more risk than lending to a government. Notice what's missing here. There's no ownership, no pie slices, no upside if the company has an incredible year. A bond is a promise written down with a fixed number attached to it. You know almost exactly what you're going to get and when you're going to get it. Compare that to a stock, which we covered in detail last video. When you buy a stock, you're not lending anyone anything. You're buying a tiny slice of ownership in a real business. There's no fixed payback date, no guaranteed interest rate, no promise of anything at all. If the company grows, your slice grows with it. If the company struggles, your slice loses value right along with it. No safety net, no ceiling either. You're not owed anything. You're just along for whatever ride the business actually has. This difference in structure creates a completely different risk profile for each one. Bonds are built for predictability. Barring something extreme, you know your interest payment and you know you'll get your principal back at maturity. That predictability comes at a cost, though. The returns are modest. Historically, bonds have returned somewhere around 3 to 5% a year on average, which barely outpaces inflation in some years and can even fall behind in others. Stocks have no such promise, which is exactly why they carry more risk, but also a much higher ceiling. Historically, the overall stock market has returned closer to 9 to 10% a year on average over long stretches of time, but that average hides a lot of bumpy years along the way, including some painful drops where the value of your holdings can fall sharply before recovering. There's one more crucial difference worth knowing. If a company ever goes bankrupt, bondholders get paid back before stockholders see a single dollar. Lenders get priority. Owners take what's left over, which is sometimes nothing at all. That's the trade-off bonds make. Less upside, but you're standing closer to the front of the line if things go wrong. That said, low risk doesn't mean no risk. Bonds can still lose you money in a couple of specific ways. A company can default, meaning it simply fails to pay you back, which is why government bonds are generally considered safer than corporate ones. And if you need to sell a bond before its maturity date, its price can actually move up or down based on interest rates in the broader economy, even though the bond itself never changed. It's not the wild swing of a stock, but it's not a flat, guaranteed line either. Let's make this concrete, because the abstract percentages don't really hit until you see them play out. Say you invest $10,000 and leave it alone for 20 years, untouched. In bonds, averaging around 3.5% a year, that $10,000 grows to roughly $20,000. Slow, smooth, predictable, almost boring to watch. In stocks, averaging around 8.5% a year, that same $10,000 grows to roughly $50,000. But the path to get there is nowhere near as smooth. There are real dips along the way. including stretches where the value drops 30% or more before recovering. The bond investor barely notices those years happened. The stock investor has to sit through them without panicking, because selling during a dip is how temporary losses turn into permanent ones. That extra $30,000 difference over 20 years isn't because stocks are better in some abstract sense. It's the price of admission for accepting volatility. The market is essentially paying you a premium for being willing to tolerate uncertainty along the way. And the only way to actually collect that premium is to stay invested through the uncomfortable years, not just the easy ones. Here's the part most beginners get wrong. This isn't actually a competition where one wins and you only pick one. Almost every serious long-term investor owns both, just in different proportions depending on their situation. If you're young and won't need this money for decades, you can typically afford to lean heavily into stocks because you have plenty of time to ride out the bumpy years and let that higher growth compound. As you get closer to actually needing the money, say near retirement, shifting more of it into bonds makes sense, trading away some of that growth for stability. So a bad year in the market doesn't wreck your plans right when you need the cash. There's no single perfect ratio that fits everyone, but a common starting rule of thumb is to take the number 110 and subtract your age. The result is roughly the percentage of your portfolio you might consider keeping in stocks, with the rest in bonds. A 25-year-old might lean around 85% stocks. A 60-year-old might lean closer to 50%. It's not a law of physics, just a simple starting point, but the underlying principle holds regardless of the exact numbers. More time on your side means you can lean more into stocks. Less time on your side means bonds start pulling more weight. Stocks and bonds were never rivals. They're two different tools doing two different jobs, one built for growth, one built for stability, and the smartest investors use both on purpose depending on what season of life they're in, instead of treating it like a one-time either-or decision. If this finally made the difference, click subscribe. Next video, we're tackling index funds and why they might be the easiest way to own both stocks and bonds without picking a single one yourself. See you there.